Nirav Modi built a multi-billion-dollar empire without investing his own equity or pledging a single asset as collateral. In 1999, descending from an established family of diamond merchants, he launched Firestar Diamond. His strategy ignored domestic mass markets, focusing instead on the international ultra-luxury elite in New York, London, and Macau. High society positioning defined the brand. Hollywood stars like Kate Winslet and Priyanka Chopra wore his pink diamonds on global red carpets, projecting an image of established, tangible wealth. As the architect of this operation, Modi became a respected figure in global finance and high fashion. He maintained the aura of a visionary entrepreneur holding massive physical assets. The logistics of this business model are incredibly capital-intensive. Holding rare gem inventory and leasing prime global real estate requires constant injections of foreign currency. This entire global footprint was financed by the largest uncollateralized leverage scheme in Indian history. The institutional victim was Punjab National Bank, India's second-largest public sector bank. Over 7 years, Modi's firms extracted over 13,000 crore rupees, roughly $2 billion, from the institution. Internal banking controls collapsed on an industrial scale. No outside hackers breached the firewalls. The vulnerability sat inside the bank's own daily protocols. An operational chasm between two pieces of banking software allowed rogue employees to create shadow leverage directly under the noses of statutory auditors. The primary instrument used in the fraud was the Letter of Undertaking, or LOU. This chart shows the standard healthy 180-day LOU transaction lifecycle. It is a credit guarantee where an issuing bank assures an overseas branch that it will cover the liabilities if its client defaults on short-term trade credit to make the payment. Receiving banks, typically overseas branches of Indian banks, see this guarantee and release funds to pay the exporter. Because Firestar Diamond was importing stones from global suppliers, these transactions took place in financial hubs like Hong Kong, far outside India's borders. The critical vulnerability is trust. Receiving banks release funds instantly upon receiving an LOU, relying on the sovereign backing without independently verifying the underlying collateral. Modern international banking relies on two distinct, siloed software systems. First is SWIFT, the global financial messaging network used to transmit secure trade instructions between banks. Second is the core banking solution, or CBS. This is the central ledger responsible for recording all accounts, transactions, and institutional balances. A corrupt PNB official, Gokulnath Shetty, recognized that these two systems were not integrated. Shetty transmitted over 1,200 unauthorized LOUs via SWIFT while deliberately failing to log the entries into the CBS ledger. This catastrophic system isolation made billions in off-book, sovereign-backed liabilities completely and functionally invisible to both the auditors and the highest levels of PNB management. An LOU is a short-term, 180-day liability. Hiding this debt for 7 years required a way to prevent the overseas banks from triggering a default. The strategy used was evergreening debt. This chart visualizes the mechanic. It begins with a single 180-day liability requiring immediate repayment. To cover the maturing LOU, Modi's firms issued fresh, larger LOUs. The new debt covered the previous principal plus accrued interest, creating an exponential staircase of liability. Overseas banks saw valid SWIFT messages and continuously funded Modi's accounts without question. The operation functioned as an institutional Ponzi scheme. It required constant acceleration, generating fresh debt just to keep the previous liabilities from surfacing. In January 2018, the 7-year scheme finally hit a wall. Gokulnath Shetty retired, removing the inside man from the PNB terminal. Shortly after, Modi's firms approached Shetty's replacement for a fresh batch of LOUs. The new official followed standard protocol, demanding the mandatory 100% cash margin to secure the credit. The firms pushed back, claiming they had always received LOUs without collateral. When the official checked the CBS ledger to verify this claim, he found zero history of past approvals. Institutional panic set in as PNB realized they were on the hook for billions that did not exist in their own accounting system. A single routine compliance check instantly shattered the shadow ledger. Nirav Modi fled India just days before PNB filed an official complaint with the CBI. The Indian government invoked the Fugitive Economic Offenders Act, seizing and liquidating his luxury assets, artwork, and cars. In March 2019, he was arrested in London. This began a multi-year extradition battle at Westminster Magistrates Court. While awaiting trial, he was held at HM Prison Wandsworth, a maximum security facility. The glamorous illusion of his Hollywood-adjacent empire ended in a British prison cell. The scandal forced a re-evaluation of India's entire banking ecosystem. The Reserve Bank of India reacted by permanently banning letters of undertaking and letters of comfort for trade credits across all Indian banks. The foundational trust in the sovereign guarantee between international banks had been irrevocably broken. For auditors, the case proves that assuming digitized banking systems automatically reconcile is a fatal professional flaw. Technology and internal controls are functionally useless if independent systems operate in silos. A simple operational gap between two platforms destabilized a century-old institution and rewrote national financial policy.